I got approved for less than I expected. Stop scrolling right now. Did you know that nearly 20% of mortgage applications get denied and even more people get approved for way less than what they expected? So I'm about to show you the exact formula the banks use to calculate your approval amount and the 3 moves that could increase your buying power by $50,000 or more. Miss this? And you might be stuck renting for another year while home prices keep climbing, so don't let that be you. Hi there. I'm Ella Gurfinkel, Senior Loan Officer with almost 30 years of experience and over 2,000 families served. I've seen every trick in the book. And today I'm pulling back the curtain on why your pre-approval came back lower than you expected and what to do about it. Here every so often, and it does get my hackles up. Ella, we thought we get approved for $400,000, but the bank only gave us $250,000. We made good money. What the hell happened? So here's the kicker. Even though the median mortgage payment dropped to $2,039 in October 2025, down from $2,067 in September, big whoop, right? $30. People are still getting shocked by these low approvals. Why? Because with rates still sitting above 6.25%, that monthly payment calculation hits different than it did when the rates were in the 3s. But here is what really pisses me off. Most loan officers won't tell you the real reason your approval is low. And they sure as hell won't tell you how to fix it. But then I'm not most loan officers. Let me break down the dirty secret banks don't want you to know. It's called your debt-to-income ratio, or DTI. And it's the number one approval killer. Banks cap your total monthly debt payments at 43 to 50% of your gross income. Notice I said total debt. That's your future mortgage plus your car payments, student loans, credit card minimums, blah, blah, blah. Even that damn Peloton that you financed. So here's a real example. You make $100,000 combined. That's $83.33 per month gross. Sounds solid, right? But wait, car payment, $450. Student loans, $300 a month. Yeah, those are back, and yes, we have to count them. Credit card minimums, $150. Total existing debt, $900. At 45% debt to income ratio, your max total debt is $3,750. Subtract that $900 that we just totaled up, and you've got $2,850 for your mortgage at 6.25% rate, being generous. That's a roughly $425,000 loan, not the $500 that you may have wanted. And here is the part that really gets people. Those student loan payments that were paused during COVID, they're back. And boy, are they back. And that's why some of you are getting lower approvals now than you would have gotten 2 years ago with potentially the same income. Now, the market's giving us some hope. We've had 5 straight months of improving affordability, and we're $88 better off per month compared to last year. But don't get comfortable. The Fed's talking about rate uncertainty for December, and home prices aren't exactly falling off a cliff. No, frankly, would they? So bottom line, if you're waiting for the perfect market conditions, you might be waiting forever while your dream home gets more expensive. And guess what? I'm sure you know those people, because I sure as hell know a whole slew of them. Clients, friends, family members, who over the last, 5 years or so, have been saying the market's going to crash. Yeah, Chicken Little, the sky is falling. The market hasn't crashed. The price haven't come down. But guess what happened to those people who were waiting it out and waiting for the prices to drop? They still haven't bought. And frankly, at this point, a lot of them can't even buy anymore because now they're priced out. Let's talk about what you can actually do about this problem. I'm going to show you 3 moves that will help. Move number 1. Attack high interest debt like your life depends on it. Pay off just $5,000 in credit card debt, and you could free up $150 to $200 in monthly minimums. Should I repeat that? That's 150 to 200 monthly minimums. And guess what? That translates to 25 to 30,000 more buying power. Do the math, right? Move number 2. Add a qualified co-borrower, maybe a parent, maybe a spouse who wasn't on the original application. This isn't about charity. It's about combining incomes to hit the numbers you need. And trust me, I do understand, and I'm very cognizant of all the perils of co-signing and how it can affect the other people. And yes, we can definitely talk about it, and we do with a lot of buyers. But the problem is that with today's housing prices in most parts of the country, I can tell you in how many instances this move by itself has helped numerous buyers get into a home versus not being able to buy. Move number 3, shop different loan programs. FHA might allow higher DTI than conventional. VA loans, if you're a veteran, there is no technical DTI there. First-time buyer programs with more flexibility. I mean, if you qualify for a conventional first-time home buyer program, or one of them, or a few of them, it means you get a better interest rate and you get a reduction in mortgage insurance potentially. So that helps you with qualifying. Every little bit counts. So don't get stuck with just one option. Now, look, getting a disappointing pre-approval is not the end of the world. What it is your wake-up call. I've helped over 2,000 families turn no into a yes and a maybe into a hell yes. But here is the thing. Every month you wait, the home prices, they keep climbing. Every month you rent, that's money you won't see again. So don't let a low pre-approval keep you on the sidelines. Let me give you one last example. I helped a family get into a home about 2 years ago where another lender issued a pre-approval for them almost $100,000 lower than what I was able to come up with. Sounds crazy, right? I'm pulling numbers out of my ass. No, I'm not. The situation was very real. Even the real estate agent they were working with at the time did not believe me when I called him and told him, you can start looking for homes $100K higher than what you've had before. I got laughed at. I was called a liar. Guess what? They switched agents. They found a home. They were pre-approved for about $400K. We got them into 500 plus. Completely legit and completely legal. Because something that got left off the table for the other pre-approval was a secondary income. Both this mother and son team, effectively, of buyers had. And I was able to plug and play it and get them into a home they wanted. And now 2 years later, I was able to refinance their loan into a much lower payment now that the rates have come down. So it's been a win-win all the way around. So always, always, always get a second opinion. And I'm more than willing to take a look at that initial pre-approval and be your guide on the yellow brick road of what it's going to take to raise the pre-approval amount so you can actually buy a home. Sometimes it's just repositioning some of the debts. But again, every situation is different. So to find out what your situation is like and what you can do, there's a link below where you can book a chat with me, and it's absolutely free. We will tear apart your numbers. We will find every freaking dollar of buying power you're leaving on the table. Let me correct it. The other lender left on the table. And you get a game plan that actually works. So stop making excuses and start making moves. Let's get you that house.